Ladies and gentlemen, Tom Lee, one of the world's best stock market predictor, has predicted that the S&P 500 will cross 6,600 points, a big jump from where we are right now. And today we'll attempt to walk through with you some of his reasoning behind and assess whether some of these reasoning are reasonable. And more importantly, for me to highlight some of the risk factors and give you some of my personal take. Let's watch on, shall we? These are my usual disclaimers. And it's very important for us to note that this is not financial advice. Let's go. The S&P 500 has hit 5,135 points, and the stock market index is creeping up towards 6,000 points, which seems to be quite elusive this few period. And I'm looking for it to break 6,000 points resolutely, and hopefully we'll hit 6,600 points. Please hit subscribe so that you will not miss some of these very important milestones. And whenever there are big market pivots, I will announce out in a live stream. And many times I know you guys are not happy, but I cannot keep those live streams as they're stock market sensitive. So please remember, hit subscribe so that you not miss those live streams. So Tom Lee has made this prediction that the S&P 500 will hit 6,600 points by end of 2025. And the reasoning behind is this, that right now he thinks that the recent stock market rally, the stock market of course have dived down quite badly, but has just returned back to where it is. He thinks that this is the onset of a new bull market, increasing his confidence in a 6,600 target. You also look at all the economic data like the ISM manufacturing index. He thinks that these index are indicating an improvement, although the ISM manufacturing index right now is still below 50. But he thinks that right now all the indicators are going up. Most importantly, he thinks that the Federal Reserve will maintain what I call a supportive monetary policy, in the sense that they think that the interest rate will be cut, especially if the inflation remains subdued, which could propel further equity market. I personally agree with him on this finding. I actually think that the inflation is now potentially going to be a non-problem, which I'll elaborate later. So another reasoning why he thinks that the S&P 500 could go to new highs is because the earnings per share of the S&P 500 companies could rise to 275 in 2025 and 300 in 2026, propelled by increase in productivity and a weaker dollar. Take note, a weaker dollar actually supports exports and therefore increases S&P 500 earnings per share. So he also used technical analysis, which I don't look at a lot, and looking at all the graphs, he predicts that, he actually thinks that the S&P 500 could actually hit even a high of 7,000 points before a pullback to 6,600 points by year end. So actually his prediction is even more gutsy. He says that you hit 7,000 points before you hit 6,600 points back. And the last point is that he thinks that Trump is very business friendly, which is the truth. And Donald Trump will do a lot of business friendly policies to make the stock market go up in time to come. So all these are what he predicted. So let's take a look at the Nasdaq so far. Looks like Nasdaq futures are going down by a little, so I'll consider it's noise. And the S&P 500 futures is also looks like it's going down by a little, so I also consider this as noise. Now, while we are very optimistic of what Tom Lee says, we also need to be cognizant that the rest of the world numbers doesn't look very good. So the Asian manufacturing activities stumbled again under the weight of Trump's tariff. And what we have right now is many PMI surveys that are being done. The most recent one that came out with is actually indicating some very bad trends. So the PMI survey so far for Taiwan shows that firms remain downbeat, which means that the numbers look very bad. And that's the same for many other countries as well. So in South Korea, there is a new data being released, which is there's a sharp fall in the S&P 500 data. And this is the worst since the pandemic. But there are some cushioning data that's coming out in both Japan and Korea, as in the hiring information and the employment information has now seems to have picked up in both countries. So maybe there's something there to provide a cushion. So uh, right now, everybody is a bit more cautious, and so everybody kind of slow down in their hiring. India, on the other hand, seems to be benefiting from all this big chaos as more and more of those production shift out of China into India, and they seem to be the beneficiary of all this economic chaos. Meanwhile, for China, the PMI data also show that there is a slight improvement in May, but it's still in contraction territory. That means it's below 50. So all still bad. So everyone is kind of experiencing a bad, but is kind of improving a little bit from the worst. Now, for Singapore, the PMI data has improved very slightly, but it is still in a contraction territory below 50. So that's not a good sign. But you know, a bit of recovery is better than nothing. So this is a couple of months of negative territory, and that's not very good. So experts now say that the supply chain disruption are becoming more frequent and less predictable. And the latest PMI data reflects slower contraction in sub-indexes such as the new order, factory output, employment, and faster expansion of input, purchase, and imports. So DBS economist Chua Hunting says that the US tariff and uncertainty and global trade friction are negative for Singapore's external demand prospect and likely to weigh down on our export orders and factory production. So we clearly are very vulnerable to all these US tariff roller coasters. And Merrill Lynch economists also say the same thing. While the US-China trade truce boosted sentiment, but the recovery growth momentum is far from being solid, with domestic demand weakening. So everything is still not looking good. So I think being happy is a bit too early. Now, while Hong Lee predicts a upswing in the S&P 500, it's also worth taking a look at the Morgan Stanley US dollar prediction. So US dollar is expected to tumble by 9% over the next 12 months on slowing growth. And this is quite serious because whatever your investment in, even if the stock market goes up, but the US value actually goes down. So it kind of cancel each other. So we must go in with our eyes open on this part. So the US manufacturing index has been declining for the third month in a row, with the ISM contracting to 48.5, even though Tom Lee seems to think that this is actually okay. But I think that this is something we need to be concerned with. So production in US is actually coming down. So now we have a lot of mixed signal, and that's something we just need to be cognizant of. As mentioned earlier, the US dollar index will fall by 9% by around this time in 2026, as predicted by Morgan Stanley. And when the US dollar goes down, the other currency goes up. That will include the euro, the yen, the Swiss franc, and also the Singapore dollar as well. Is this good or bad depending on where you sit? You know, if you are a importer of US goods, then that's good. But if you're an exporter into US, then you know your goods become more expensive. If you're holding a lot of US asset, that will turn against you as well. So to date in 2025, the US currency has weakened over 5% against the Sing dollar and is set to go down even more. And that's something we need to go in with our eyes open. Why is the US dollar weakening? Well, it's weakening largely because there is a rate cut expectation. So now I think the whole market is prepared that the US Federal Reserve will cut the interest rate. And that's actually very good for stock market and potentially good for bonds, but that's not necessarily good for our holdings or US asset that's denominated in US dollar. And then we convert back Sing dollar, also it's going to turn really bad. And there's also a increased risk appetite of people moving their assets out of US. And there's also a concern about the what we call twin deficit. There's a trade balance deficit and the fiscal deficit that is most concerned. There's largely being consumed by the financial world, and all this has set the US dollar to go down and down and down. So what's the key takeaway from all this? Well, to judge whether Tom Lee's prediction is correct or not is really to see whether there's going to be inflation or disinflation or even deflation in US. With all this tariff war that's going on right now, we're not sure whether it will result in inflation or disinflation or deflation. If there are no inflation, then interest rate will likely to fall and stocks and bonds are likely to go up. And my personal take is that I think that even if there's inflation, it's going to be a lot short-lived. And I'm not even sure whether there's going to be inflation. Right now, with all this softening of economic data, I think inflation rate is set to go down and may even turn negative. But however, whatever the trajectory may be, the S&P 500 and all the globally diversified index is likely to go up over time with a lot of volatility in between caused by Donald Trump flip-flopping like a roti prata. And as a result, the news I announced will have to flip-flop as well. But I think we need to be eyes open that the US dollar will likely to fall, and I would say fall significantly, and this is an eventuality. So whatever we gain in our S&P 500 or other globally diversified index will be partly eroded by some of this US dollar fall. Right now, my take is I'm holding tight to my own portfolio and wait out all this turbulence because the dust will ultimately settle. There's just going to be a lot of turbulence in this ride as we ride through 2025 and maybe even go into 2026, but eventually all these will come to an end. So let's watch on and pay attention to what's happening real time. Remember, hit subscribe as I report to you what's happening on real time basis. I'll see you. Bye bye.